Welcome back to Talk Tickers. Today we are digging into one of the most interesting growth stories out there in the beverage space.
Dutch Bros, ticker BROS.
Exactly. We're looking at their Q3 2025 earnings call from November 5th, and there is a lot to unpack here.
There really is. This is a story with a real split personality. On one side, you have just flawless operational execution. They are a traffic king.
But on the other side,
you have this, incredibly demanding valuation, the valuation queen. So any tiny imperfection gets magnified, and that's why we saw so much volatility after what looked like, on the surface, a really great report.
Okay, so let's start there. Give us the snapshot, the top line number.
They were strong. Revenue hit $423.6 million.
Which is a, 25% jump year over year?
25.2%, yeah. And it beat what the analysts were expecting by about 3%. So a really solid beat on revenue.
And earnings per share.
Also a beat, mostly. Their adjusted EPS came in at $0.19, which was 2 cents better than the $1.17 consensus.
Okay, so far so good. Why is it? Well, mostly.
Well, this is where the nuance starts to creep in. Their GAAP EPS, which is the more standardized accounting number, was $0.14.
And that was a little under what people were hoping for.
Just a bit. The consensus was closer to 16 cents. And when your stock is priced for perfection, a 2-cent miss on a GAAP number, that's enough to plant a seed of doubt.
Right, because that number includes things like the real cost of their growth, the stock-based comp, all the stuff they adjust out for the other number.
Precisely. But the real story, the reason the stock actually spiked at first, was the traffic.
This is their superpower.
It really is.
Yeah.
System same-shop sales grew 5.7%. But here's the kicker. 4.7% of that was pure transaction growth.
Wow. So it's not just price hikes. They are actually serving more customers.
Yes. And this is the 5th quarter in a row they've done that. In this consumer environment, getting more people through the drive-thru, that's a huge win.
It's a massive differentiator. So that explains the initial pop in the stock, up about 4% after hours?
It did. But then reality, or I guess valuation reality, set in.
And by the next day's close, it was actually down 4.2% from where it started.
A complete reversal.
Right.
And that right there is the whole tension of this stock. Yep. The market loves the execution, but is terrified of the price tag.
Okay, so let's dig into the numbers that gave management the confidence to, keep pushing this growth story.
Sure. So adjusted EBITDA, a key profitability metric, hit $78.0 million. That's up over 22% from last year.
And that gave them enough room to raise their guidance for the full year.
It did. They bumped up the revenue forecast to about $1.61 billion on the low end. And more importantly, they raised their same-shop sales guidance to around 5%.
So they're telling the market this demand isn't slowing down.
Exactly. And they're backing it up by building more stores.
How many did they open in Q3?
38 new shops, bringing the total to just over 1,081 to be exact. And they made a really big point that these new stores are performing at record levels.
And their long-term plan is still insane.
It's ambitious. They reaffirmed the goal of hitting roughly 2,029 shops by the year 2029.
So they're basically going to double the size of the company in 4 years.
That's the plan. They're even accelerating the pace, talking about 175 new shops for 2026.
How do you even do that without something breaking? The execution risk seems enormous.
It's a huge bet. But management points to those record average sales per store, the AUVs, and says the demand is there, the model works, and they can scale it. It's a high wire act for sure.
So let's talk about what's actually driving that traffic. It's not just new stores, it's strategy. Digital seems key.
Digital is like the central nervous system for them. Their order ahead business is now 13% of all sales.
Which is pretty solid.
It is. But what's really interesting is that in their newer markets, that number is almost double. New customers are just adopting digital from day one.
And the loyalty program, Dutch Rewards, that's the engine room.
Absolutely. It accounts for 72% of all their transactions now.
72%.
Yeah, it's a huge number. And it lets them be really smart with marketing. They can send targeted offers to specific groups instead of just, blasting out discounts that kill their margins.
Okay, what about the other big lever, the food program? They're rolling that out more widely now.
They are. It's in about 160 shops, and the early results are pretty good.
What are they seeing?
About a 4% lift in sales at those stores. And the interesting part is how that lift breaks down.
Okay.
About 3/4 of it is just a bigger ticket, people adding a muffin top or whatever. But a full quarter of it is new transactions. So they're getting new people to come just for the food.
But there's a catch, right? I remember hearing that not every store can even handle the new food items.
Exactly. That's a key constraint.
Right.
They said about 25% of their stores, just because of the physical layout, probably won't be able to accommodate the hot food.
So there's a ceiling on how much this can boost the overall company?
There is. And that leads us right back to that friction point we talked about earlier, margins.
Right. This was the big question on the call. They raised revenue guidance, but they just reiterated their profit guidance. Why didn't the profit outlook go up too?
Two big things are eating into that extra revenue. First, coffee costs are going up, and they expect them to stay high into 2026.
And they're choosing not to pass all of that on to the customer.
Right. They'd rather protect the traffic they fought so hard to win. Second, it's just getting more expensive to grow. They're spending more on pre-opening costs, flying specialized training teams out to these new markets to make sure the culture is right.
That makes sense. An investment in consistency. And then there was that weird one-off regulatory hit in Q4.
Yeah, a bit of a headache out of California. A change in payroll tax rules is going to hit their Q4 labor costs by about 0.5% of margin.
Ouch.
It's a timing thing. Basically, a full year's worth of the tax change hitting all in the last quarter, but it definitely adds to the, near-term pressure.
So all this brings us back to that fundamental conflict. The business is firing on all cylinders, but the stock is it's priced for something beyond perfection.
It is. Management keeps talking about being in a category of its own, and honestly, based on the traffic numbers, they might have a point.
But the valuation.
The valuation is brutal. The stock's trading at, 109 times trailing PE multiple?
For anyone listening, what does that actually mean, 109x?
It means you are paying a price today that assumes decades of flawless, high-speed growth. It means there is zero room for error, a slight miss on GAAP earnings, a hint of margin pressure, and everyone runs for the exits because the safety net is just not there.
And what about competition? Are the big guys starting to encroach on their territory?
Management was asked about that directly. A big competitor has been piloting energy drinks and iced coffee in Colorado, a key Dutch bros market.
And the impact?
They said they've seen zero impact on their sales. Zero. So for now, their competitive moat seems to be holding up.
And that moat is really built around their people, the baristas.
It's their whole brand. They even cited a QSR report that ranked them #1 in order accuracy, satisfaction, and drink quality. That all comes back to the culture they've built.
Okay, this is the perfect setup for our next segment. This is not financial advice. This is a thought experiment, a trade idea for a stock that's this complicated.
Exactly. You have two camps here. The people terrified of the high multiple, and the people who believe in the perfect execution all the way to 2029. The idea is to build a trade that sort of plays on that tension.
So how do you capitalize on that?
The play would be a long-term sort of synthetic stock position using options. You're trying to capture the upside from their growth in 2026 and 2027 while, sidestepping some of the near-term cost headwinds we just talked about.
Okay, walk me through the structure. How does that actually work?
So tactically, you could sell a short-term put spread that's at the money. The money you collect from selling that spread helps finance the trade.
Okay, so you generate some cash up front.
Right. Then you take that cash and you buy a call option that's way out of the money, but also way out in time, like expiring in early 2027.
So you're making a highly leveraged bet that the stock will be significantly higher in, say, 18 to 24 months.
That's the idea. You're basically saying, I accept the short-term margin noise, but I believe they'll execute on that 175 store plan for 2026, and that will ultimately force the market to recognize the growth and justify the premium. It's a bet on future perfection.
That is a very specific, high conviction take on a very complex story.
I like it. So let's wrap this up. What's the key takeaway for you? Dutch Bros delivered on traffic, they delivered on revenue, they raised guidance, but that's still not enough.
It's not. The challenge for them isn't operations. It's bridging the gap between their excellent execution and a valuation that demands something that's, beyond excellent.
It's a tough spot to be in.
It's the high multiple tightrope, and that leaves me with a final provocative thought for you to chew on.
Let's hear it. Okay, so management credits everything, their entire advantage, to their people-first culture. Their operators have been there an average of 7.5 years. That's who protects the brand experience.
Right.
The question is, as they double their footprint over the next 4 years, going into brand new states where nobody has heard of them, can that unique culture actually be scaled? Or is some level of cultural dilution just the inevitable price you pay for growing that fast?
And that question probably determines everything. Whether they stay the traffic king or the valuation queen finally gets dethroned, we'll have to watch. Thanks for joining us on this deep dive.